Investors are welcoming softer than expected inflation data out of the U.S. The September Consumer Price Index was finally released after a delay because of the government shutdown, giving markets a lift. Meanwhile, on this side of the border, Canadians are reacting to Trump's announcement saying he's terminating trade talks with Canada. For more on this, we are going to bring in David Doyle, the head of economics at Macquarie Group. It's good to have you, Mr. Doyle. Thanks for taking the time.
Thanks for having me.
So let's start with that news of Donald Trump terminating trade talks between Canada and the U.S. Real big news here today. Mark Carney came out saying that they were making some headway when it comes to trade on certain sectors. The White House saying that negotiations weren't really going that well. What do you make of this?
Look, I think there's a lot of posturing that's going on here. As the USMCA comes up for renegotiation next year. I think you're going to see ebbs and flows to this. I do think that eventually we'll see some sort of a deal. We'll see what's constructed in that regard in the end. But in the meantime, there's going to be a lot of uncertainty for businesses, particularly in Canada, that are reliant on the U.S. market. And that uncertainty is going to be, I think, an ongoing drag on our economy, for the coming quarter and even into 2026.
Yeah, the Prime Minister is saying today that they're making headway on talks about steel, aluminum, and energy. You mentioned, markets, obviously, certain markets in Canada are going to be really affected by this uncertainty. Is there any in particular that you think are going to be hardest hit the quickest by a talk of no trade talk at all?
I mean, I'm just going off of the news reports and the anecdotes that I'm hearing, and it does seem like the auto sector is under disproportionate pressure. I'd say that sector has been a big point of focus for the Trump administration. You saw that come through with the Section 232 tariffs that were announced earlier this year. And Canada seems to be, more impacted than other countries when it comes to that, at least from the announcements we're seeing, where we're seeing closures of facilities in Canada and the indication that the production that was occurring there may move to the United States.
When it comes to the markets reacting to this news, do you see any reaction at all to this announcement by Donald Trump?
Well, I mean, I think you see, the FX market certainly still pays attention to what Trump is saying. So it certainly weighs a little bit on the Canadian dollar's performance for sure. The overall market, though, seems to be more focused on the outlook for monetary policy. And there, as you mentioned at the outset, we had some encouraging news this morning with a downside surprise from the Consumer Price Index. So you're seeing equity markets a bit of a risk on in that context. But still, Canada, I think, faces some headwinds from that uncertainty with what the future trade relationship will look like with the U.S. And messages like you got from the U.S. president overnight certainly haven't been very helpful in that regard and may continue to weigh both on the performance of the Canadian dollar as long as this is going on, but also on overall Canadian growth, because it's going to be a difficult environment for businesses in Canada to decide to invest, to grow when you're not sure what's going on with the largest trade partner. So we're hoping that maybe you'll get clarity on that at some point later next year. But in the meantime, again, that's going to be an ongoing source of a drag on the economy and should inhibit or prevent the economy from doing too well in the meantime.
Yeah, okay, we're going to keep our eyes on that and continue to follow this story throughout the day, but we're going to turn to something else that you also mentioned. Of course, that's the CPI data for the month of September coming in for the U.S. It looks as though inflation up by 3%. Do you think that guarantees rate cuts in the next month and then also in December?
Well, I never say in this business, you got to be careful about using the word guarantee. It certainly makes it highly likely and cements a rate cut next week, I would say, from the Federal Reserve. We actually think the Bank of Canada will also do that and cut by 25 basis points next week. I'd say when it comes to the December meeting for the Fed, I would say it makes it more likely. I think that's a little bit further out, so we can be a bit less confident in that. But it looks like the data are going to be supportive of a continued easing cycle here. Where I get more trepidation in terms of the forward-looking outlook for monetary policy is when I see the market pricing sort of ongoing cuts in the U.S. Into 2026. I think the outlook is a lot more murky. When you go out that far. And I actually think that the economy looks like it's doing, could be doing okay by the time we get to into 2026. And potentially the market is sort of, I would say, ahead of itself in terms of expecting continued rate cuts, in the first half of 26. So we'll see what happens on that front. But I'd echo your point that it does look almost certain, not certain, we're never certain, but almost certain that they'll cut next week by 25 basis points. I expect that. And then, increasingly likely that they may move by another 25 basis points in December. It's just beyond that I think the conviction starts to diminish.
I take your point. Can't guarantee anything. I take your point on that. You did talk about the markets and the fact that they're reacting today to this news. Obviously, we're seeing it looks pretty positive for the markets. The S&P 500 broke a record this morning. What do you make of what we're seeing today when it comes to the U.S. markets and this news of the CPI data?
Yeah, I mean it's exactly the kind of data the market's looking for, right? So markets like low inflation, and when it looks like inflation has turned downward, markets will celebrate that, especially in the current context where, one of the major concerns of investors was that a upturn in inflation could derail the prospect of near-term hikes, and the fact that we got the opposite probably has made people, believe more in this theme that you're seeing everywhere of a Goldilocks sort of trade where you have low inflation and okayish growth, which markets have historically liked. So I think that's a big part of what's fueling the equity market gains. I think probably the risks for 2026 are skewed towards, the potential for more stronger economic growth potentially than what some people are expecting. And of course, if you get that stronger growth and the labor market in the U.S. turns upwards again, potentially those rate cuts that the markets are currently pricing in 2026 are priced out again. So maybe there's a source of volatility, but I think that is, a few months away. And in the meantime, we probably have continued strength in equities for now.
Okay, we'll have to leave it there. David Doyle, head of economics at Macquarie Group. Appreciate you joining us. Thanks for your time.